Hello, everyone, and welcome to another episode of the Reinsurance Podcast. I'm your co-host, Jerad Ben.
And I'm Ben Rose.
Good to see you, sir.
Thank you very much. I've just knocked my microphone ever so slightly. It's like wobbling indefinitely. No, it stopped. There we are. The shortest and most exciting tangent to date to get on.
We'll do better next time. More tangents to come.
Brilliant.
But this, you wanted to discuss sort of very current affairs sort of topic this time.
Current affairs. That means we can trend in the current affairs category on various podcasting sites, as well as the mental health and zone out and so on categories. The great music category.
Indeed.
We'll start to move into business and current affairs.
How do we hack the Spotify algorithm is the new objective.
Indeed. Yes, so actually kind of a sad current affair, which is maybe the word that is used most frequently with current affairs at the moment. We couldn't find a good one to talk about in a lot of faces. So let's have a look at how the current global economic environment is impacting the various stakeholders in reinsurance land. And quite specifically, I guess, the word that we're seeing thrown around now is the word recession, which most of us who've been around have seen one of these before. They're not pretty. They're followed, though, by a boom afterwards, we hope. But possibly a bit differently in the past, because I think with this example, obviously there's a lot going on right now. I don't know if you want to highlight any of the things around the world that's driving this, Jerad, but...
Yeah, I mean, you have the very obvious conflict in the in Ukraine. You have sort of the spike in gas prices as a result of that. You have all manner of inflation across both the U.S. and the U.K., which I feel recessions in those two economies push a lot of other sort of global impact because it impacts trade and all manner of other things. So it's driving a big shift in kind of outlook and confidence, economic confidence that the consumers have. So I think people are really bracing for this to be quite uncomfortable for a couple of years.
Yeah, and I think part of the reason, as you said there, is we're seeing, I guess, some kind of monetary policy responses that are not quite up to the task in some ways, right? Because of having had interest rates sit so low for so many years, and then suddenly, quite recently seeing really high inflation. So taking the UK as that's the market I'm most familiar with, we're seeing in May and June of this year inflation of like 10%, for example. And then coming from a base of interest rates of like 0.75%. Yeah. I think they got increased by Andrew Bailey to like 1% in response to that. And it's not really proportionate in terms of the scale of impact that you'd hope one of those things had. But everyone's having to be really careful. The usual stimulants that you'd try and supply to the economy just aren't going to be able to keep up.
Yeah, well, and I think we started off from a bad position following the pandemic. Like we were starting from a very lower negative base around had countries been investing in and building up debt to offset the challenges they faced, the economies faced in the recession or in the pandemic, and now you add on top the global conflicts and electricity and gas prices and everything else. So now, as you're saying, you were looking at this was going to have a bit of a pain point anyway, and it's been sort of worsened as we're trying to wrestle with everything else. But yeah, you're right. You come from historically low interest rates and things. So now we're trying to wrestle with what is the future, what do the next sort of few years look like.
Yeah, and I guess for our listeners who maybe from the industry as much as from outside the industry who have already, his eyes have already glossed over listening to the first part of this episode. Should we just go back over some of the key terms we just used and maybe make sure everyone's familiar before we dive deeper into this story? Maybe I'll start with inflation. We hear about it all the time, but what is it? I'm going to hold up my prop of the day, which is this exceptionally expensive orange juice bought from the cafe downstairs.
Yeah, it's the very simple concept that things cost more than they would have done in a sort of slightly different time horizon. Obviously, it's very easy to look at larger and longer time horizons and get a sense of how prices have changed, but inflation is really felt when that shift happens in a more condensed window, right? If you look at the juice, for as an example, if the price of juice has gone up 30% in a year, that's very painful. If the price of juice goes up 30% over decades, the cost of living has risen with it. But there's always going to be an element of that sort of just naturally occurring. But it's when you see it spike more painfully, this sort of cost of living increase that sort of outstrips the income growth in incomes and everything else, you begin to really wrestle with things cost more than they used to cost.
Exactly, and I think the number that's deemed healthy, or at least the target for in the US and the UK, for example, it tends to be about 2% inflation per year, so that it's manageable and predictable for everyone how much prices are going to change. It's easy then to help it fit roughly in line with salary growth and so on as well. What we've found, I guess, interestingly here is that some very, very core elements of our consumer and commercial shopping baskets, I guess, have been hit, especially by energy. This is one of the biggest categories, right? If you look at fuel prices at the moment, I went past a petrol station or a gas station. Which is very confusing because we don't call it gas here. Gas is something else. We went past one the other day, and they'd gratuitously decided that they'd put both petrol and diesel up to £199.99 per litre, which I thought was so kind of them to show us that it was still under two, but much higher than we've seen.
In the US, they oftentimes have decimal points to the penny, so it's like £4.50.9. They won't say £4.51. $4.51. They would add this 0.99 of a cent. It's weird.
Wow.
It's weird.
Okay, I see that.
But in I think in the US right now, the average price of petrol or gas is, I think it's $5 as of today. So if people are tracking when this was, like, that's very, very high. But then you also had this introduction. You mentioned in the description, when you have inflation kind of anchored around 2%, most bigger employers and things, you hear with this sort of idea of cost of living raises or cost of living adjustments, where every year most jobs, or at least salaried jobs, adjust a little bit, and the intention of those little raises every year is to kind of help people calibrate to the rising cost of living. What you've seen more recently is the introduction of stagflation as kind of a concept, which is not only are we having inflation happening where cost of living is going up, but a stagnant economy that sort of sits next to that, underneath that. So people aren't expected to get raises. People aren't expected to get more, take home more money, but the cost of all of their goods and services is going up, which again is making this a very difficult time for a lot of consumers.
Absolutely, and I think going into the predicted recession now, we will probably see, in fact, jobs being lost in many sectors, and that's already been reflected in stock price falls around the world, where these big employers are seeing that their value is not going to be what they thought it was, and therefore that has a consequent impact on the amount that they can invest in people and so on. So we will come on to the knock-on effects on insurance and reinsurance in a moment, but I just wanted to finally touch on interest rates as well, because we talked about that. Basically what we see happening here is the sort of key holders of monetary policy, so the Bank of England here and the Federal Reserve in the US and other similar institutions around the world, controlling effectively the borrowing rates that can be used by other banks. And what this effectively enables them to do is to influence how much consumers and businesses are willing to spend versus how much they're incentivized to save. And they try and use this to stimulate economies where needed, or to encourage people to save where needed in response. And as we were saying at the beginning, typically when you see inflation rising, interest rates are put up as well to try and mirror that. But it's not currently comparable, I think, just because those interest rates have been anchored so low over the past few years. Yeah.
But this wouldn't be the Reinsurance podcast if we were to ignore what this means for the industry. One of the things that's often discussed with reinsurance and why it's an interesting asset class is this idea that it's a non-correlated asset class. And I wondered if you could dive into that, what that means a little bit for the audience.
Yeah, so when we talk about correlation here, we're talking about whether a set of things are expected to behave in a similar way. The things in this case being usually prices or the value of something. Now, in the case of most companies and most businesses, they are very tightly tied to the economies that they operate within, because their customers, whether they're corporate or consumer, tend to spend less on their services or similar if they're in a recession than they would during an optimistic growth period. So typically all of those stocks suffer during a recession. If you look, though, at a different type of value and you're valuing the risk of something, so with a stock, so with a corporate stock, you're valuing the risk of that company's future success or future failure in the price that you assign to that stock. If you're looking there at the value of pure risk, in the sense of will an event happen, you start to be able to explore insured or sometimes less insured events by talking about, for example, natural catastrophes and saying, how likely is it that the wind will blow or that a hurricane will pass through this particular set of states in the US, or that an earthquake will occur in California? And those types of things are not impacted by the prevailing economies in terms of whether or not they will happen. Yeah. So for that reason, we call them non-correlated assets. And if you're able to set up vehicles, be it through an equity base of, relying on insurance companies who rely very closely on those types of things, you can use that. But there's also debt instruments that focus specifically on that, like catastrophe bonds, insurance-linked securities more generally, that try to give people who want to invest in risk the opportunity to get exposure to these non-correlating asset classes. So if your portfolio as an investor or a pension fund or anybody really contains mostly stocks, then during a recession, your portfolio is going to reduce in value most likely.
Yep.
However, if you've got a bit of non-correlating insurance risk in there, then the probability is that those prices will stay the same, on the same trajectory that they were on, regardless of how the economy is performing.
Yeah.
Although there is a caveat here, which is that this is why we wanted to talk a bit about inflation at the beginning. Let's say that hurricane that happens regardless of how the economy is performing, if that hurricane blows through and inflation is high, then the cost of paying the claims for that hurricane is going to be higher. So that's one example to think about. Secondly, if there's a recession taking place and a hurricane blows through, people generally are going to have less money and are likely to lean more to potentially fraudulent insurance claims, for example, if they haven't got the spare money to pay for something here or there, or even they just need to get money and so they find a way to suggest that a claim has happened that might not have happened otherwise. So there's quite a few ways that this supposedly non-correlating asset class can actually trigger some of these insurance claims, and it's only in some very clinical parametric covers, I think, where we've seen it not based on indemnity, that you can get that true pure insurance risk. Indemnity being the concept in insurance of putting someone back in their original place, which takes prices into account, versus whether something happens or not being the primary driver of whether you're effectively going to be impacted by the economy.
Yeah, and you have this process where there's always an element of that being linked up, and I'm sure you'll have economists from like Munich Re and Swiss Re who have really spent a lot of time diving into what is the increase in things like fraud during certain economic recessions and hardships and things, because everything is so interlinked. It can't be 100% non-correlated. But in much the same way that you'd diversify any traditional portfolio, you'd have some of your investments in sort of technology stocks and other investments in, big institutions or Fortune 500s or just general market trackers. this idea that certain parts of that market might be more volatile than others or respond more significantly to certain events than others. This is another sort of vehicle that they're linked. There's a bit of a connection, but it's loosely coupled, which makes it an attractive one where they can look at it going, I mean, we know there's some link, but it's not so tightly coupled that you're stuck if something were to go off.
Yeah, and you could argue in some ways that actually insurance as an industry on the equity side is actually doubly linked to the economy in some ways, so even more so, because as we talked about with Harold on the corporate strategy episode, a lot of insurers effectively use insurance premiums, so the policies paid for by their customers, to create a float of a big fund, basically, or a big pool of premium that can be then used as a vehicle for investment. So it's with this big pool of premium, they are able to invest in a variety of things which probably will be quite strongly correlated to the economy. However, actually, this is quite an interesting piece because most insurance companies want to be very sure that they're able to pay out claims, so they tend not to have very large proportions of their investment portfolio in riskier assets. So you won't see many insurance companies with huge stock portfolios. They tend to focus more on very predictable things like government bonds, where often the yields on those bonds are fixed and known, so they know exactly how much they're going to earn from holding those bonds, and they don't have to worry about the risk of default as much, unless, of course, the government's collapse, which is a very difficult scenario. But they'll tend to have a much safer portfolio of assets, which, again, for the very advanced listeners out there, you'll probably be familiar with what then starts to happen with bond prices depending on interest rates, because if those yields are greater than the yields from interest rates versus or not, that can also have quite an impact on how the bonds that you hold are priced and so on, which again can affect your interest, so your investment return as an insurer, which might be there to prop up that non-correlating part of the insurer's book, which is, did the claims happen or not?
Yeah.
Unless, of course, those claims were affected by inflation and by fraud and all these other factors.
Well, and you look at it, and there is this sort of liquidity that sits across the entire value chain. But if you think about in a very traditional business sort of structure, when you have traditional insurers and backed by traditional reinsurers, the market feels relatively stable in that way. But when you introduce third-party investment vehicles as a source of capital to provide reinsurance capacity, now you've introduced an asset class that people sometimes move that money elsewhere. And if the investment that's being put in, that's deployed as reinsurance capacity, is taken out and deployed into other parts of the market or elsewhere, that reduces the supply side of reinsurance capacity, which has these sort of knock-on effects. So whilst it's protected to some degree and there's an interest in this being a stabilizing area to attract that investment, if that investment leaves, you see a supply and demand shift to some degree, which kind of has this knock-on effects. So
and to continue the knock-on effects, it's quite interesting. So you have then potentially, driven by a recession, you have, as you say, exit of capital from unprofitable insurance assets of some kind, which reduces supply of capital potentially, which then means that arguably prices can go higher. There's less competition, so a harder market, so prices increase. Plus, you're finding that your claims are likely to be more expensive than you charged for because of the likely inflation of claims since you collected your premiums. Thus, in order to strengthen reserves, the insurers that still remain, or the reinsurers that still remain, have to put up their prices, which in turn then means that consumers and businesses face higher insurance prices, which means their overall basket of goods increases, which drives inflation, and so on, right? So you end up then very easily getting into, and this is just a very insurance and reinsurance example, but in a vast array of segments across the market, you end up finding the risk of quite vicious circles or vicious cycles.
Cycles. With no confidence in that answer.
Well, one of those things. But really accelerating the pace of these things.
Well, and this is where, and I think that's a really great way to frame it, because we talked in one of the first episodes about how much of the world insurance touches. But if the price of insurance goes up a little bit, and you look at the orange juice, how many companies along the sort of supply chain that goes from the orange growers to this cup that you're drinking it out of are touched? And if the insurance is bumped up a little bit across all those parties, every one of those parties adjusts a little bit to cover their basket price, as you were saying. The aggregate effect of that to the very end consumer is felt sort of in orders of magnitude more, because there's a little bit of a bump at every step of the way, because everyone has to pay a little bit more for the shipping, a little bit more for the business insurance, a little bit more for the, the sort of supply chain insurance that's along the way. And so all those little things can add up and have an impact on what we end up paying at the till. So it's a very interconnected space.
And so then salaries might increase too.
Yeah.
And it carries on. Wonderful. So one of the other things that we wanted to talk about then is I guess, what you can do if you're an insurer or a reinsurer going into a recession, or a broker for that matter. If you're sat there now and you've seen the warning signs, the writing is on the wall, as they say somewhere. Yeah. What should you be thinking about at this point? What should you be doing?
I think it's going to be similar to how many businesses respond. There has to be an element of assessing where your business sits, what the needs are, where costs can be removed. But this is, when you talk about the cost of doing business in our industry, the sort of expense ratio that we have, it doesn't give people a lot of space. To sort of find places to save. But businesses are looking like, how do you begin to offset how much you're expecting to pay in claims, or how much you're expecting to raise premiums in order to account for things. So there's a lot of difficulties, I think, as businesses brace for this, especially in one that's as essentially critical to the global economies as this one is.
Absolutely. I know we wanted to cover a funny claim of the week, which I want to come on to soon, because I know this is a very technically intense episode. But I just wanted to introduce one other complicating factor, I guess, which is we haven't really discussed lines of business in this episode as well. So obviously, insurers and reinsurers specialize in particular parts of the market, so be it motor or cargo or homeowners, whatever it might be. Do you see any particular lines being affected more than others potentially by changes in the economic environment?
Ooh, I don't. I'm sure someone who studies this full time certainly would. Like an economist from Swiss or Munich would definitely have an opinion on this. I think the one that you're seeing, especially around the cost of claims, that's really interesting, is you look at something like motor. Cars have gotten vastly more technologically capable, where little minor accidents that previously would have been a couple $100 to fix. Think about a rear view mirror or something. Those are now very expensive because there's all manner of sensors and lights and indicators and things built into that. So that's one area. I don't think it's directly impacted by the current inflation piece, but I think perhaps business insurance, like small business insurance, might be impacted more. I'm not sure. That's a really interesting thing to think about. Is there an line of business that you think is going to have more of an impact?
I mean, there's some smaller ones, I guess, that are not huge. Well, I mean, they are. Few insurance lines are small.
Yeah.
In terms of the amount of premium they collect, but I'm aware there's a number of lines around income protection, for example.
Mm-hmm.
If we start seeing lots of jobs going, then there's a very specific spike in
credit risk, perhaps.
Yeah, credit risk is a brilliant one as well. Yeah, we'd expect to see more default in general on any kind of debt. So those are probably more directly affected in that sense. In terms of, as you say, cost of claims, it's interesting to think about whether you think of industries that are very heavy in fuel, for example, like cargo and aviation and so on. I don't know the extent to which that would affect their insurance, if at all. But
yeah.
And then I guess the broader category then that came to mind was the long tail market, in the sense that to what extent will these inflationary periods at the moment have a exponential effect on future claims? Because if you're accounting for claims that come in several years' time or aren't discovered for many, many years' time, those insurers who've reserved, a few years in advance, and are now experiencing much higher inflation than they priced for. That's then potentially an area of quite substantial concern.
This is an area of real concern for insurers. As you said, you've put aside, especially in long tail business, reserves to account for claims that you expect to happen. You have enough information and research on your book to know that a certain number of claims are going to come in. But if, as you're saying, now the expected cost of those claims is 10, 15% higher than you maybe had planned for it, how do you begin to start doubling down in your reserves and backing those up to make sure you're protected in case? It's a very stressful time, I'm sure, as they have their teams and their actuaries and stuff working on this.
Absolutely. And so to lighten things up a bit, given we've just covered a very technically challenging concept, we have our claim of the week, which should be quite entertaining this week, although I have to do my best to put it in a very diplomatic way.
Okay.
And to not upset our listeners at home.
Keep it safe for the children.
And I don't have a source for this one. This was one of those rare occasions where insurance made it to the dinner table at my brother's dinner party the other day, which was very funny. So apparently there's currently a lawsuit in progress in the US relating to a car insurer.
I did.
Have you seen this already?
Yes.
You've already seen it. Okay.
This would be very NSFW for the audience.
Well, apparently, let's just put it like this. Apparently, literally any injury, which is a broad term, or illness or disease that you incur whilst in a vehicle, no matter what you're doing with that vehicle or within that vehicle, apparently it may be covered according to some courts in the US. So we'll see what happens as that goes through the higher courts. But I've probably said enough for people to use their imaginations. But apparently motor insurers, you're on the hook for whatever people do inside their cars. So sorry about that.
Someone caught a disease in a car and the motor insurer is potentially liable. Yeah. Which it would make underwriting drivers very different if that...
It would, wouldn't it? Can you imagine the policy form changing questions?
Yeah.
Well, anyway.
Yeah. This might be one we have to update on later on and circle back and determine when they rule on this, what happens, because the knock-on effect of that would be very, very interesting.
Yeah, we will examine the mechanics as always.
Yeah, and a caveat for this episode: neither of us are economists.
I have done though actually the wonderful Chartered Insurance Institute set of exams. So many years ago, I did. I'm pretty sure I did. I remember I did the economics module, which. My little tangent on this one is, so I used to take my exams, in London. I think all of the CII exams are done in the huge exhibition halls at the Excel Centre or something. So they put 1,000 young insurance enthusiasts into this room to go and do their exam. And I found out that actually my hometown in Shropshire was also a registered CII venue because they had a small insurance economy there a long, long time ago. And so I thought, I might pop home for the weekend if I can book the exam on a Friday. We'll see what it's like. And it turned out they were hosting the exam in this lovely old hotel, and they set out for all the tables like a white tablecloth, the same as they use for weddings, and put on there, when I arrived, they're like, would you like a drink or something, sir, whilst you do your exam? And they had brought me a coffee and a glass of water, and it was about 3 of us in the entire place. It was peaceful as you could imagine. I do remember the economics paper there, because the various curves that had appeared throughout the textbook, I remember thinking, okay, I get the general point, and there's no way they're going to ask me to draw them. But that is exactly what happened during the exam. They said, now take out the pencil that you've been asked to bring to this exam, and please draw the curve, the elasticity of demand curve or something. And I was like, oh dear, this is going to be bad. But fortunately, I survived. I did pass.
Did you subsequently ask for a pencil?
No, I was unusually well prepared.
Good job
for that occasion. So,
and you're like, I'll never need this again. Fast forward 5 years to the Reinsurance podcast.
Exactly. That's an interesting point, though. Maybe that's a good final thing to cover on this episode. So, the elasticity. That's quite a confusing collection of vowels to accommodate. The elasticity of demand for insurance may also change as a result of the changing outlook for the economic environment, because as you look at your basket of goods as a consumer or as a business, and you're trying to work out what you can afford to save on, potentially the extra insurances that you bought last year, but maybe you're looking for somewhere to cut costs. Maybe you don't buy them again this year, or maybe you slightly underrepresent the amount of exposure you actually have in order to pay a lower price. We've seen,
or a shift towards policy minimums, like in the U.S. Like motor, for example. There's what you're required to carry by the state. A lot of times people purchase a bit more protection, but if means are tight, you will cut back in areas that you don't feel are as pertinent. So
indeed.
With that, what an episode. Whew.
Yeah, I'm sure
Thank you,
you'll all
everyone,
be
for hanging on to that.
Yeah, go away and review your insurance spending and think carefully about it.
Go have a nap after that one. Perfect. Thank you, everyone.
See you next time.